Welcome back to this channel, and today we are looking at question number 22 of business data analytics. They just concluded December setting, and I will read it through. The question was under the financial management, specifically project evaluation techniques, where they were testing the return on investment, the NPV, the IRR, and even profitability index. And they combined all of them in one particular question. So I will read. It was question number 22. Mustard Limited is planning to launch a new product branded Malinex beginning January 2025. The following data relates to the launch of the product. So I've been given the end of 2024, which will be the beginning. It will be our opening or year 0, 25, 26, 27, 28, and 29. It was a project of 5 years. We've been given the initial investment, resale value, production and sales quantity. These are in units, selling price per unit, variable cost per unit, total fixed cost, and these are, remember, they're in thousand, and even the depreciation is in 1,000. Additional corporate tax will be charged at the rate of 30% and is paid annually at the end of the same year when earned. Tax will also apply on the dispose of the machine at the end of the project life. So when we dispose, we shall pay the tax. And remember, we normally pay the tax on the gain. The tax is normally charged on the gain on disposal. Depreciation is the same as capital allowances. Depreciation is the same as capital allowance. Working capital of 20 million will be required at the beginning of the project. This will increase at 5 million for each of the 4 years, and then released at the end of the project life in 2029. So you are required to compute the return on investment, ROI, of the project, compute the project after tax cash flow over the 5 years, then plot a graph of the project net present value profile given the weighted average cost of capital ranging from 1% to 15%. Then determine the project's internal rate of return. Then compute the project profitability index at 10% weighted average cost of capital. So that is our question. So the first thing that you are to do when you are dealing with this particular question is before we calculate the ROI, we want to calculate the after-tax cash flow. You want to calculate the after-tax cash flow. That was the first part that you are to begin with before we compute the ROI. Before we compute the ROI, let us start with the after-tax cash flow. We'll start with this part. Compute the project after-tax cash flow. And for this one, we are having 2024, the end of 2024. And I'll drag this, or I will autofill up to 2029. And I'll have the bottom border, so that the first thing that we need is to find the project after tax, and we have been given the production in units. So we have our units there, and we have been given the selling price. So I can just start with sales because already have the units up there. Already have the units, production and sales quantities, selling price. I can just directly start with sales. Our sales that we shall receive starting from 2025 here, and we have been given the production and sales quantities. So we take the quantity and multiply by the selling price. Quantity by the selling price, and I will first have shillings in 1,000. That way, 1,000 separator. 1,000 separator, 300 million, and this one I'll drag that one, that way. So that will be our sales. That will be our sales. Then this one I'll have it on that end. So that is our sales. Then after sales, we have the variable cost. We have our variable cost. And for the variable cost, it varies. Variable cost varies again with units. So we take the units and multiply by variable cost per unit. variable cost per unit. And again, this one I will drag that. After getting the variable cost, the next thing we have what the total. Yeah, and when you look at the total fixed cost, total fixed cost is in 1,000. Is in 1,000. So that one you can multiply and just put 1,000 here, convert it, and just put 1,000 there. So fixed cost, so that it is in 1,000 fixed cost. I will pick my fixed cost. Yeah, our fixed cost, total fixed cost here, and the fixed cost here we have been given at this one. I will multiply by this, multiply by this, and I will lock the 1,000, so that it will pick all the fixed costs in that particular order, but now multiplied by 1,000, so that we are using the same amount. If they are in 1,000, all of them are in 1,000. We have not omitted any zeros. And depreciation, we have been told, is the same as capital allowance. So we have depreciation, yeah, depreciation. Again, we shall multiply by 1,000. Multiply by 1,000 because they are shillings in 1,000. They are shillings in 1,000, and I will lock that 1,000. And again, I will autofill that way, and we'll get our earnings before tax. EBT, earnings before tax. Here we shall minus sales. We minus variable, minus fixed, minus depreciation. That way. And I will autofill this. And I will use the top border. Use the top border. So that is our earnings before tax. So we shall have our tax. Our tax. And our tax rate is 30%. Our tax rate is 30%. 30% for the tax rate, yeah, 30% for the corporate tax. So this one will be, we take this one multiplied by 30, which we shall lock again. It's a constant. 30% is a constant, and I will autofill that. And we shall have our earnings after tax. Earnings after tax, yeah. I'll take this and I minus this one. So this will be our earnings after tax. I'll autofill, use the top border, and after getting the earnings after tax, we shall add back depreciation. Remember, depreciation is non-cash. It's a non-cash item. Depreciation is a non-cash item. Shall add it back there, and shall get our cash flow. Our cash flow. Before we get the net, that's our cash flow. So we shall add the two. We add these two. So this is our cash flow. That way. So the other thing we know is we had the reseller. Yeah, we have the resale value. Resale value. So we are reselling at 70. Yeah, we are reselling at 70. Yeah, the resale value. Resale is like the residue. We shall recover it in the last year, 2029. So 70, and we multiply by 1,000. Remember, the resale was in 1,000 of shillings. Resale, and we multiply by 1,000. Yeah, that is our resale value. Then we have our initial cost, the project cost, initial investment, initial cost, or initial investment in year 0 or end of year 2024, 500. But again, we multiply by 1,000 because they are shillings in 1,000. Shillings in 1,000. Yeah, that way. I'll just adjust it. Yeah, that one is enough. So that is our initial. The other thing that we had is working capital. Working capital of 20 million will be required at the beginning of the project. Here we have working capital. Working capital of 20 million here. 20 million will be required. Working capital of 20 million will be required at the beginning of the project. This will increase at 5 million for each of the 4 years and then release at the end. So it will increase by 5 million. 5 million. Yeah, so it will be increasing here. We shall take this and we add 5 million, which I will lock, so it's a constant that it will be increasing. 30. Yeah, that way. So cumulatively it will be 40, so it will increase by 5 for the first 4 years, 25 to 28. Then in 29 we shall recover 5 million for each of the 4 years and then release at the end of the project life in 2029. So remember, each and every year, so we have been increasing. The cumulative will be 40. Here is what we shall recover. The 40 we shall recover in 2029, but here we shall have what we call the change. Change in working capital. Change in working capital. And for the change in working capital, here from year 1, we take this and we minus this to get that particular change in working capital. The change in working capital. The last one, it will be 0. Shall not have that change. And again, we have tax on disposal. Tax on gain on disposal. Normally we tax the gain. So the first thing to get the gain, remember we sold it at 70. We first find the accumulated. It had accumulated of what? We do out of sum. Accumulated was 415. Accumulated depreciation. You can say accumulated depreciation is 415 million. The cost was 500. Our cost here was this 500,000. So that means our net book value, by the time we are disposing it, it had a net book value of this minus this. It had a net book value of 85. It had a net book value of 85,000. And the proceeds, so the disposal, we sold it at 70. We sold it at 70. We sold it at 70,000. That is what we sold it at, 70, because they are saying that in note 1, corporate tax will be charged at the rate of 30% and is paid annually at the end of the same year when earned. Tax will also apply on the disposal of the machine at the end, so it's on disposal. So remember, we don't tax the 70. 70 is the proceeds. So we don't tax the proceeds, we tax the gain. Tax normally is charged on the gain or loss. So here, if we dispose at this, we had a loss. Loss on disposal. Loss on disposal, and our loss will be this minus this. So we sold it at a loss of 15. So our tax, savings on tax, tax on savings, may change this. It should be savings. Savings on tax, on loss, loss on disposal, because we dispose it at a loss. So we shall save that. I'll put a negative so that I have a positive value multiplied by 30%. So we shall save 45. 45 will be our savings as a result of selling it at a loss. So our net cash flow, that we shall have here, it will be the two of them. We shall add these two. But here we shall take this minus the increment, change in working capital, up to that point. For the last one, we shall take this, we add the resale value, that is the salvage, and we add the working capital because it will be released. Working capital will be released, and we add the 45, which is a savings, what we are saving. As a result of selling at a loss, we shall save 45 and we shall get 199. So that will be our cash flow for that particular period, cash flow for that particular period. That is our net, the net cash flow that we have. The net cash flow, that is according to number A, our net cash flow. Yeah, our net cash flow. And that is part B, compute the project after tax. Yeah, these are after tax cash flow. Yeah, the after tax cash flow that we are having, after tax cash flow for the 5 years. Then you can compute the project. Yeah, you can calculate number A, what we call compute the return on investment. So the return on investment, ROI, this one will be equals to net after tax cash flow, net after tax cash flow, and we minus initial cost. Minus initial cost. I'll put bracket there, and we shall divide by the initial cost. Initial costs. We shall have our initial cost. So here you can have the bottom border of the initial cost, and later on we shall multiply by 100. Multiplied by 100. Yeah, that will be our ROI. So after tax cash flow, net cash flow after tax, net cash flow will be here, this one, alt equals here, just need this sum from this point to this point. Yeah, so it will be 634 100 at that particular point. That is our net, this from this to this. So that means our ROI will be here. I'll open the bracket, I'll take this and I minus, our initial is 520. I close that, I divide by 520 the initial cost that way, and I enter. This one I will convert it to percentage, and I can increase. Yeah, 21.94 should be our return on investment. So our return on investment, it should be 21.94. 21.94 as our return on investment, Then that was part B. Yeah, part B, 21.94 as our return on investment. Then the other part was part C, where we are supposed to plot a graph of the project net present value profile given the weighted average cost of capital ranging from 1% to 15. Yeah, so here we shall have our WCC 1 to 15, 1%. We shall have 1%, then 2%, in that order, up to 15%. We shall drag this up to 15. 15 is somewhere there, up to 15, and we shall have our NPV here, net present value. So here we shall take our NPV, and we need the rate. So the rate will be this one, comma, our values. This will be our values, which we shall lock. They will be constant, so we lock that. We close the bracket and we minus our IO. Which is 520. We minus our IO as 520. We'll get that. And the IO is supposed to be locked again, a constant. And here I'll just autofill. you'll find that that is your NPVs. That will be your NPVs. That will be your NPVs. Yeah, NPV for that. So the next thing that we shall do, remember for this one they were awarding how many marks? 1 to 15, 5 marks again. Yeah, 5 marks for this one. So I'll highlight this and we insert the recommended chart, and here we shall take this for the NPV. We shall use a scatter. Yeah, this one that will show our NPV as a line. Yeah, that way. So that will be our NPV. Yeah, the graph, a graph of our project net present value profiler. So it will look like that. Yeah, some of them are negative and some of them are positive. Some of them are negative and some of them are positive. That is our graph of NPV. Graph of NPV. Yeah, you can decide to use either with color or without color. Yeah, so whichever way, you can decide to use that as a black one. Then the other number D of our question, that was number, so we determine the project IRR, determine the project internal rate of return, So we have our cash flow. So we shall have our year first. Here, the way they are here from end of 2024, end of 2024 supposed to be here that way, and I will drag this up to that. We shall have our cash flow, and our cash flow here we have this. These are our cash flows that we have here that way, and because I need these, so this one is I can put these to be 520 negative 520. Yeah, negative 520 million, negative 520 million, so that my IRR, internal rate of return here, it uses all the values IRR. So just need the value from here to this one. You'll find that you have an IRR of 6%. You have an IRR of 6%, IRR of 6% that way. Then the last one is a profitability index. We had this one where we need to compute the profitability index at 10% weighted average cost of capital. So remember, at 10% we had this a negative. Yeah, at 10% we have a negative NPV. So at 10%, so first we shall find what we call the PI, profitability index, is equals to PV of cash inflow, PV of cash inflows, and you divide by PV of cash outflow, So PV of cash inflows over PV of cash outflow. So here, for the inflow, PV of cash inflows, and this one is at 10%. Our WCC is at 10% here, 10%. So I'll check here as our NPV without minusing. Our rate will be 10%, and our values, I'll just pick this that we have here, and I'll enter that way. That will be our cash flows that we have there, and our inflow, PV of inflow, PV of outflow, cash outflow. So outflows here, you can use a negative, this one, So our profitability index PI, therefore we shall check this one divided by this one, we'll get 0.9 as our profitability index, and that is all that was required for this particular question for 20 marks. That's what you are required to calculate for 20 marks in this particular question, and continue subscribing if you are new to this channel. Continue subscribing so that you can get all the other questions. So far we have tackled question number 21, we've tackled question number 23, question number 23 already we have tackled, and now question number 22. So we are remaining with two questions, question number 24, and question number 24 is for taxation, and question number 25 for auditing the specialization area. So far the core area we have already been able to tackle that. Check the other question 21 and question number 23 in this particular channel. So thank you.